There's a lot of nuances.
Yeah.
I mean, if you were, wearing blue jeans on a Wednesday and your last name started,
Yeah, exactly. Yeah, you need to know all these nuances. There's a lot.
Congress likes to complicate things.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Good morning.
And today we're going to talk about RMDs and then a couple things going on in the markets with the Fed having a meeting coming up and just a couple hot topics. So let's just jump straight into it. So RMDs. So this is something that a lot of people that we work with that are nearing retirement or in retirement, are very interested in and want to learn more about, need to learn more about. And, it's applicable for everybody that has money in retirement accounts, tax-deferred accounts. And so it's a good topic to touch on, and it's actually a lot more complicated than you might think, especially if your situation's not very straightforward. So RMDs, what is that? So that's the required minimum distribution. So it's the minimum distribution that you have to take out of your retirement account, your tax-deferred accounts, at a certain age. Okay, so a few years ago, it was 70 and a half. Mm-hmm. They've changed it, 73. If you were born after, I think, 1960,
Yep.
It starts phasing out. For some people, it's as late as 75
Yep.
now. So somewhere between the age of 73 and 75, if you've not already started your RMDs, that is when you're going to have to start those. So going to kind of jump into a couple highlights here of, things that are most applicable, most important, and then we'll get into some of the details. But RMDs, like I said, required minimum distributions, those are based on the life expectancy table that the IRS puts out there. So there's there's a formula, there's a life expectancy table that says, hey, this is how long we think your life expectancy is based on your current age, and so this is how much money you need to take out. So what you do is you take the ending balance for last year. So at the market close December 31st, if you go back and pull last year's December statement or fourth quarter statement and look at the ending value, that is going to be the value that you use to calculate your RMD. And then you would essentially take that and take the value on the life expectancy table and divide the value by the account value by that number. Okay. So if you pull up like a uniform lifetime table from the IRS website, it might say like your number based on your age is 21 or whatever, so you would take the account value, divide it by that number. What that comes to very roughly, but is about 3.65% in that first year is what you have to take out for most people. So that's kind of the quick, we're going to get into some details in various scenarios here. That's kind of the quick summary of what RMDs are and how they're calculated. Any initial thoughts or?
Well, I'll just say, like in our careers of doing this, a lot of people mistake RMDs. Like I've had people think that, oh gosh, at 73, I'm going to have to take all my IRA out, which is incorrect, right? It's a very small amount. It gradually goes up as you get older. So by the time you're in your 80s, mid 80s, it's kind of a lot higher amount. The IRS is trying to get that distributed out before you pass away, basically. Yeah, right. I mean they're trying to. And so when you get in your 90, I've had a client that reached 98 and still had not exhausted their IRA, because the numbers are, even if it's at 50% of a small amount, because it keeps getting smaller, you always can have a 50% of all the time.
If that's all you're taking out.
Right, if that's all you're taking out.
Then your account hopefully is still growing.
As long as you're earning more than the 4%-ish.
So the dollar amount can actually grow to be quite large if your account continues to grow, even if the percent is growing.
We don't expect anybody to go to the IRS tables. What's nice is, anybody can Google RMD calculator.
Yeah, like Schwab and Fidelity, they all have like tables and calculators.
And, you have to know a couple dates. Now, where it does get a little different is if your beneficiary is not your spouse.
Yeah, right.
If it's a child, then those factors are a little bit larger. But you're right. The government expects, when you're looking at it, that it's going to zero out at your death. But to your point, especially over the last 20 or so years with the market doing so well, many people begin their RMDs, and when they're in their 80s, 90s, have double what they had to begin with. And so we just lived through a time when most IRAs, if you're taking simply the minimum, it's not depleting the IRA.
Yeah. And there's different situations, like Lee mentioned. There's the kind of standard that's applicable for all unmarried IRA owners, married owners whose spouses aren't more than 10 years younger, and married owners whose spouses aren't the sole beneficiaries. There's a separate life expectancy table if you have a spouse who's more than 10 years younger than you and they're the sole IRA beneficiary. There's a separate life expectancy table. And then there's a single life expectancy table for those beneficiaries who are not the spouse of the IRA. So you often use that when you've inherited IRA from a grandparent or someone that wasn't your spouse. Some changes that took place not too long ago was, we used to have the ability to stretch IRA withdrawals over your life expectancy.
That went away.
Now you have a 10-year period. If the person you inherited the IRA from was already receiving RMDs, you have to continue that each year and still have the IRA completely withdrawn in 10 years.
Yes.
If they weren't already receiving RMDs, you still have to have, if you've just recently inherited since 2019, I think it was when that passed, you still have to have it withdrawn in a 10-year period. You don't have to take their RMD, but you do need to take an RMD based on your life expectancy still. So there's a lot of different caveats to that go into what you need to take and when you should take it.
And you said something at the very beginning that's so true, that there's so many nuances to the rule. One rule is if you're still working, at age 73, RMDs do not kick in, to your 401k. However, if you have rolled part of that 401k out to an IRA and are still working, it does kick in to the IRA portion. So there's a lot of...
If you're at least a 5% owner of a business with a retirement plan at 73, you have to take your RMD, which is a little unknown rule. And that the other stuff, when back in the day, companies have gotten so much better at this. Fidelity, we mentioned all these big companies now, they give you a warning, right? It used to be a lot of people didn't get warnings or notice, and there's a lot of people that failed to take their RMDs. And if you do, there's a 25%
excise tax.
Penalty
tax
on the if you don't. Now you can get it reduced to 10 if you take it within a year or so of
I think it's 2 years.
Yeah, within 2 years. So, but just nowadays we don't let that. Like at our firm here, we are diligent about making sure everybody meets their RMD requirement. Right, we don't let people fall through the cracks. But I think that's important if people don't have anybody out there to know they have to get that done.
Yeah.
A couple accounts, retirement accounts that you don't have to worry about. Roth IRAs.
That's one.
Roth 401ks do not have required minimum distributions. If you inherit a Roth IRA or a Roth 401k, you do have RMD requirements.
Yeah, the inherited
those distributions are tax-free, but essentially they don't want you to leave that money in there forever.
For 6 generations.
Yeah, and it continue to grow and never have to
taxes.
pull it out and start putting that money back into the system where it can be taxable. So you do have to slowly unwind that. So Roth IRAs, Roth 401ks, you don't have to worry about.
I will say this, it's pretty important to know this, like the 10-year rule, like we have to take this small amount every year, and our clients do that, and we've got, several clients in this mode, but that 10th year can be a pretty big withdrawal, right? Because you're making money on that money. You're required to take a really small amount. So I think it's very important to be planning
to have a plan.
Out. Yeah,
we typically do not. Maybe there's exceptions in situations where it could make sense, but we typically do not say let's wait until the 10th year.
Right. Yeah,
you're needing to take a little bit of amount out each year, anyways. So unless you're expecting some drastic change to your income down the road, maybe then it would make sense to delay that and take it in those later years. But oftentimes it makes sense to be kind of unwinding it over that 10-year period just to limit the big impact in any 1 year or two.
And correct me if I'm wrong, but during that 10-year period, there's not a required amount.
Each year?
Each year.
There's a percent.
You're supposed to take it. You're still supposed to take it based on your life expectancy.
You're on your life expectancy.
Correct.
That's correct. Okay.
But I don't think, to Lee's point, I don't think there's a penalty, though. And I've had clients that have taken, just a random amount.
Right.
And they've just kind of gone. And I've had several that have skipped a year because they were retiring a couple years from now and they wanted to take it all out at once, and they've been able to do that without penalty. So I'm actually not quite sure about the required if you get penalized like you do in the other.
That was my point on that.
You do have to take it within the 10 years, but I think you can stretch it how you want. Now,
there's a lot of nuances.
Yeah.
I mean, if you were, wearing blue jeans on a Wednesday and your last name started,
Yeah, exactly. Yeah, you need to know all these nuances. There's a lot.
Congress likes to complicate things.
Yes. Yeah, I mean, it depends on a lot of things, like who you inherited it from and different things. So,
okay.
But now, one last thing I'll say on this, that this is one of our big planning tools, right? Because when we bring clients in and we talk about legacy planning, for example, and what kids are gonna inherit from you and so on. One of the big kind of things to this, let's say you are 80 and you pass away and you leave a massive IRA / 401k, old 401k to your kids who are in their prime earning years, and they've got to stretch this out over 10 years. It can put a lot of strain on the inheritors, if that makes sense, right? So when we do planning, we talk about all kinds of things like Roth conversions early on, so you don't have as much in this position, in the RMD position. But anyway, that's just all going, big planning.
One thing that kind of last point on this, unless you guys have anything else, one big thing that we look at is for those clients or those people that are charitably inclined and give to their church or charity, something that you can do from a planning perspective is, utilize the qualified charitable distribution option to satisfy your RMD requirement. You can start that. This is kind of the weird thing. You can start that as early as 70 and a half. So they did not change that age when they changed the RMD age. So you can start that before your actual RMD age requirement. But that allows you to send money directly from the custodian. So whoever holds your IRA or retirement plan account, you would have them send it directly to the nonprofit or charity. So it never comes to you personally. That amount that you send out goes towards your RMD requirement, but is not taxable income to you. Yeah. So there can be
and
some
you get
good
the charitable deduction.
Yeah, and one key note on that, when we're doing really good planning for clients, right, that's a question we ask. Are you charitably inclined? Do you give to your church and so on? If the answer is yes, then there's an argument, like even if you're doing really heavy planning, you're going to Roth convert so you don't have RMDs, you don't have to worry about that. It's all in Roth by the time you get to that age. You still leave some behind so you can do the QCD, because it's a really awesome way to gift to the church, and it comes from that non-taxed money that you don't have to pay taxes on, goes to the church. It's fantastic planning tool.
It's like the HSA for charitable giving. It's like money goes in tax-free, grows tax-free, and then it's withdrawn out of the account tax-free.
Yeah, it's fantastic. There's really cool ways to plan around this stuff.
Yeah. So RMDs, definitely, know what they are. Be aware of what your situation is. They can be a little bit more complicated than you might think, depending on your situation and all of the different variables that can go into that. So just make sure you have someone that you're working with, or do your own research and know how those need to be handled for you. So, all right, John. So you mentioned rolling into kind of some things going on in the market right now.
Well,
you got a Fed meeting coming up. And
we're so sick and tired of talking about the Fed. I know we are, right? Seems like it's always on the top of our mind because we're in this rate cut. Are we going to? Are we not? Now it looks like obviously tomorrow morning they're going to have their meeting. If they don't do a rate cut, I would say the market's not going to like that at all. Yeah. It's priced in, right? We think it's going to happen. There's a second hearing, or there's a hearing going on tomorrow on the hearing is held on Thursday by the chairman of the Senate Committee on Homeland Security and Government Affairs, Rand Paul, titled "The Fed's Big Bank Welfare Program: Oversight of the Fed's IORB Regime." It's very interesting. That is not going to be talked about like tomorrow, but it's a pretty high-profile Senate hearing, right? And in that hearing, and you're going to find out, like, Trump's going to announce, at some point next spring, we know in May, our current Fed chairman's term is up, and he's going to have a new chairman in, and the rumors are flying of who that's going to be and so on. But one thing we do know, there's probably going to be some changes made in the Fed, and they could be pretty dramatic. Mm-hmm. And so I'm reading through this article of like what they're going to talk about, and I'm not going to get into it in the weeds here, but after the meeting, I might have more detail of what went on. But the expectation of what is coming down the pipe, they have not changed some of the Fed policies for 100+ years. Mm-hmm. And our markets and interest rate environment, economy, everything has changed dramatically in 100 years, right? If you think about it, we have things that we have not changed for a long time. And then there's things we changed, like in the financial crisis, that we don't need to have in place anymore. So I think there's a lot of big changes coming that could benefit the overall market and economy, make the Fed a little bit more, I don't know the right word, but have a little bit more accountability, so on. But this is coming down the pipe. So that's on Thursday. To me, that's a really important, non-talked about meeting that's going to happen. Give us a little foreshadowing what might happen in May when we have a new Fed chairman. But anyway, that's after the Fed meeting tomorrow, which is, again, we all expect no fireworks. We expect a quarter-point drop. We expect the Fed chairman to say that maybe next year it won't be every month there's a quarter-point drop, maybe every other meeting they might, but it's going to still continue to have interest rate drop through the next year or so. That's what we expect to hear tomorrow.
And one thing that you're beginning to hear is both sides, they're hoping for a hawkish cut, meaning they're going to cut, but they're going to kind of begin to pull the reins back a little bit. It'll be interesting to see how the markets react to that, but you're beginning to hear more and more talk of, yes, we're going to give you a hawkish cut, which means the comments related to next year's cuts will be even more important. And I think most people are thinking 2 to 3 more, early half of next year, and then be done for a while. We'll see.
Yeah, it's amazing how bad information is good for the market sometimes, because they like if you have unemployment issues or inflation issues, whatever, it's like, okay, well, the Fed's going to do what we want them to do in the market, but that doesn't mean that the economy is necessarily running on full cylinders.
Yeah.
It's kind of like it's kind of a weird dynamic to our markets and what we're watching.
As tough as things have been on the consumer, inflation and so forth, retail sales are good. When you talk to the retailers, Christmas season seems to be, pretty good. Now, we'll see how much of that's on credit cards, but, at least the early signs, and I think that's one thing that's kind of continuing this forward momentum, is things tend to be decent.
Yeah, there's a lot going on. You've heard a lot about the K-shaped economy, and how people that are the higher income, higher asset, people that own assets have done just fine, or doing okay. Yeah. The people that don't, are really struggling. Mm-hmm. This is a completely different stat here, but something that I think is interesting, and kind of just share some insight into to how the economy and the jobs market and things are just not what they were a couple years ago. If you look at wage growth for the job changers, so that increased 6.3% year over year in November, compared to 4.4% increase for job stayers. So the 1.9% gap between the two groups is tied for the narrowest since 2001.
Interesting.
And so the median, So it just tells you that, hey, changing jobs, like trying to jump, is not as lucrative, if that's the right word, as it has been for over 24 years now. Yeah. It's the jobs market's tough, and people aren't, employers are not having to go out and stretch and pay people
to keep
what they were, because a couple years ago it was like the Wild West. It's like you change jobs, it was like 20-30% pay raise, you go do whatever you want, and employers were having to overpay in a lot of situations to get the right people, and that is completely flipped upside down, and where we're at. And so the environment is different. I think people are realizing that the job market's tough, and staying where you're at and trying to maximize what you can get there is probably the best call for now.
I think what you said, the K-shaped thing, is really important. And I heard something today that the Trump administration's approval rating is going down, and the midterms, which are a year away, but in America, we always talk about elections all full time, but there's going to be some shakeup in Congress and so on, because here's the deal. The young people in this country they want to feel like they belong, and they want to be able to afford housing. They want to be able to afford stuff. And I think you're talking about the K-shape, and I think there's a problem with, and it's a lot of our 30 and unders that are having trouble finding the job that is equivalent to their college degree, the massive debt that they accumulate in college, and then they go get a job that doesn't help them pay that debt and so on. It has becoming a problem. And young people, whether it's right or wrong, they're going to look for change, even if the change doesn't bring them what they expect, right? Sure. So that's kind of something that I think this current administration and so on should be very much paying attention to, and trying to help. Again, I always go back to let's get this where the average home buyer entry point is not 40. Let's get it down to 35. Let's start helping out the younger folks. That's I don't know how exactly you do that, right? What magic thing you can do right now to make that happen, but that's a stressor point in our economy.
Yeah. Well, my opinion is just stay out of the way, give people opportunity, and
to let them. Yeah.
It'll work itself out.
Yeah. Well, I think the government likes to think that they should and have more control over all of these things than they really do.
Sure.
And there are levers they can pull that can maybe ease or provide some temporary relief, no doubt. But over the long term, it's like if they would just stay out of the way, and
it would work itself out. Well, but you also
the people who are willing to go out and find the opportunities will find them, and those opportunities will be presented because they're willing to go out and find them. And it really will. It sounds simple, and there's probably a ton of people like, you're an idiot. The government should, send everybody paychecks every month, But
oh no,
it's just
I don't think that.
It's over the long term. What's the most sustainable is the government make less decisions and let people make more of their own.
Libertarian.
So,
which I like.
So real quick, I want to finish on this. This is just an interesting stat. It has nothing to do with anything we've talked about today.
Yep.
But Dogs of the Dow, right?
Yeah.
Well, how long has it been since you've heard that?
It's been a while.
Okay, so this year's Dogs of the Dow, the 10 stocks in the Dow 30 with the highest dividend yield. Okay, so those were up 21% year to date through November, putting the Dogs strategy on pace for its best year since 2019. The other 20 stocks in the Dow are only up half as much at 11.5%.
Crazy.
So it's kind of interesting. Yeah. It's been a while since we've seen those kinds of companies do well. So,
and you may see them do even better as rates
come down.
Yep.
Money will flow into
there's
definitely
definitely a shifting. A shift that's happening in the markets, right? Doesn't mean that some of these companies that have done incredibly well over the last few years won't continue to do well, but I think a lot of people are starting to realize, this exponential growth in their stock price.
Yeah.
The companies may continue to exponentially grow, but that doesn't mean the stock price has to.
You can't
They can trend higher. And so I think people are starting to look for, okay, where are some other opportunities? Where are some companies that have underperformed with rates coming down and an interest, in an environment with rates declining? And so you start to see some of these things, and as investors and advisors, I think we'd all agree we like to see that. There's other opportunities in the market and ways to make some money.
Yeah, it all comes back down to earnings, and earnings in these high-flying Mag 7 stocks or just the entire, AI kind of sector. As long as earnings keep up with this massive growth, they can sustain, but it's much harder.
Yeah,
it's harder to sustain a 50% growth or, whatever crazy growth rate we've had. It's hard to sustain that long term.
Yeah.
And it will flow back. I think small cap and the European markets have been really good this year. The international markets have done well. Small cap is starting to show signs of really strong recovery. The market is shifting.
Yeah.
It's spreading out, which is a healthy thing, in my opinion.
For sure. Well, any parting thoughts or
No, I'm checking out the Dogs of the
words
Dow.
of wisdom?
I mean, they're the bluest.
They're
the bluest of the blue chips. I mean, if you look at the list of the 10 right now.
Oh yeah.
I mean, they don't get any bluer.
Yeah.
Who's on that list? Do you know?
Verizon leads the group. I mean, Johnson & Johnson, IBM, Coca-Cola, McDonald's, Procter & Gamble, Chevron. I mean, those are
Yeah, boring names like the last 5 years, but they're doing well this year, which is great.
Yeah. And they pay a nice dividend, which for some people that's nice.
Hey, last parting shot I'm going to say is if you ever come visit us, make sure you talk to Matt about his coaching. He's coaching his son in basketball, and he comes and tells us stories every day. They're pretty hilarious, but
I mean,
he's a really good coach, right? Is what he's trying to get across.
It conjures up Bobby Knight.
Yeah, little Bobby Knight.
Yeah.
With
I'm not throwing a chair yet, but
a kid or two, not a chair.
I will say if you ever feel really good about yourself and you're kind of getting
go watch some go coach some 10-year-olds.
Go coach 10-year-old basketball, and you will be humbled. Quickly.
Yeah.
So
it's a fun stage of life.
Yeah,
it is a fun stage, and I miss it greatly. Enjoy every minute of it.
Yeah, it is a lot of fun. Well, we appreciate you guys watching and listening. As always, give us a like, subscribe, shoot us an email with questions. We'll be sure to address those. Hope you guys have a Merry Christmas, and we will see you guys soon.
Take care.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.